Hey, if you're going to take the SIE exam, the Securities Industry Essential exam, one thing that is pretty important to know is the difference between an ETF and an ETN. ETF is more of an equity security, ETN is more of a debt. Boom, if I have a heart attack now, that's probably good enough. But let's go deeper. An ETF is a pooled investment security. They buy a bunch of different securities. That's what they do. So they buy a bunch of different securities, and then the value of those securities inside the pool determine the value of the ETF. And they can be wildly specific, like, oh, we just want to do tech, or we want to do a broad like the S&P 500. Anyway, you can pretty much choose the way you want it. And the good thing is it's almost like being diversified right away, because instead of you trying to pick out like, oh, I want to buy a little IBM, a share of GE, you just buy an ETF and you're almost instantly diversified. It's a great way to get into the market, put your toe in, and not have to pick stocks. You can just go, oh, I like this industry, so I'm going to buy an ETF on that industry, and they're going to hold all the stocks. Good thing is they're pretty transparent. You can pretty much see the percentage, the goal percentage they want of each security. Like, GE is 2%, Gillette is 4%, IBM is that. You can see that, unlike mutual funds where you can't see that stuff. They just show you like the top 10 holdings once a quarter. Now, an ETF, when I say passively managed, what they do is they don't actively try to beat the market. What they're trying to do is match the market. So they just buy the securities. And what I mean by passively is that they're not going to try to beat the market, like I just said, because I'm repeating. But every quarter, they're going to look at the securities and go, oh, you know what? IBM, its percentage, because it rose faster than the rest. That it wouldn't now. But it rose faster than the rest. It's out of kilter with the rest of the percentages. So they're going to rebalance it and bring it back to where it was. So when you buy an ETF, it's passively managed, so the fees are lower. You're buying an actual pooled security, so you don't really have the same risk that, like, if you buy an ETN, which we'll talk about, where if the company who issues it go bankrupt, you're kind of screwed. An ETF, let's say UBS issues an ETF. They wouldn't, but say they do. And UBS goes bankrupt. You still have all those securities that they're holding in the ETF, so you don't have to worry about it too much, because you just basically, the ETF is still strong. They'll sell the ETF, the securities, and you'll get most of your money back. Okay, that's an ETF. You have market risk. You do have systematic risk. You really don't have non-systematic or business risk because you are diversified. Now let's talk about an ETN. ETNs are usually the last thing you're going to recommend to someone because they are a debt. Okay, exchange traded note. ETN, exchange traded note. It's a debt. So what happens is, like, let's go back with UBS. UBS will say, okay, we're going to track the FANG stocks, Facebook, Amazon, Netflix, Google, stuff like that. And you're going to lend them money, $50, $100, whatever it is. And at the end of the period, 10, 15, 20 years from now, because remember, note means that, at the end of the 10, 20, 30 years from now, you're going to get your money back, the $50 or $100 that you paid, the principal value, plus or minus whatever those securities have gone up or down over that time. So if they've gone up 1,000%, you're going to get $100 plus another 1,000, whatever it is. So you're going to get that. Now that's great, but you're not getting anything during the life of it, no dividends, no nothing. But it is a debt. So they don't actually own the stocks. They're just tracking it, okay? So they're just tracking that index, okay? And you're going to get whatever it is at the end. But if UBS goes bankrupt, then you just become a creditor of UBS. There's no securities. They're not holding all that stuff, okay? So that's where we are with that an ETN has, not only does it have the market risk, it has default risk because they don't actually own the securities. So if the company fails, you just become a creditor of the company and you hope you get the money. Just like if you own shares of Lehman, hopefully, if you're a creditor of them or you lent them money, hopefully you get your stock back. Hopefully you get your money back. Now, on that note, so ETNs and ETFs for the normal investor probably couldn't tell the difference by looking at them because they both trade on an exchange. You can buy them both on margin. You can short them both. They both have leverage, which means you can get a bigger return, which I have other videos on. You can do inverse, which means you can go against the market. And remember, if you're bullish on the market, you do inverse, okay? I think that's, so remember, ETF is more of an equity. It doesn't have default risk. ETNs have default risk, okay? That's the big thing. They both have what they call tracking error. Tracking error, what the hell is that? Well, remember, the index for tracking is absolute. Like, if you have a bunch of stocks, they go up or down, that's a percentage. But as an ETF or an ETN, you have costs, rent, salaries, margin, interest, all that stuff that's going to reduce your income. Also, ETFs are pretty damn fucking liquid. ETNs, while in theory they could not be, okay? So they're not as liquid as ETFs. So let's go through ETFs. You have market risk, not business risk. And that's kind of it, okay? No liquidity risk really. ETNs, you have market risk, default risk, you have some liquidity risk, and actually both of them have tracking error that you may not earn exactly what the index you're tracking is. Hope that helps a little bit. I know it went long. I usually try not to do one topic videos this long, but if it's an easy couple points on the SIE, why not do it? Check me out on YouTube, Tuesdays and Thursday nights, 8:30 p.m. Eastern. Be there.